Good afternoon. This Tuesday, August 23rd. Grain futures having a solid close yesterday on poor results that we're finding in the Western Corn Belt, and Ohio not stacking up like we'd like to see. Well, and then the crop ratings came out after the close, dropping that corn from 57% to 55% good to excellent when an uptick was expected. This would be of the worst four in the last 20 years, but the second worst since 2012, which definitely makes an eyebrow rise on what they're seeing out there. As we roll into Iowa and into Illinois, more importantly, Illinois and Indiana, they should find some strong yield potential there to help offset. But in the end, we are finding crop prospects that confirm that the USDA was correct earlier in the year by not going with a trend line yield of 180.5, 181 bushels on the corn. They went to 177. So we're already default down 4 bushels. And so when they put the data out on August 12th, of 174.9, they're already now moving at 5 bushels or more below what would have been a trend line expectation on the year. So how much more lower this can go? Well, understand if we take it down to 72 to 73 bushels to acre, at just a round number using 80 million acres harvested on corn, you quickly lose 240 million bushels of carryout, and boom, we're right back where we were last year and the year before with carryout right on pipeline supply. Well, that just gives you shots of corn well over $7. And let's add into the equation later on this year that Europe may be buying corn from the U.S. as well, since they have kicked back the GMO requirement they can buy from the U.S. during this crop year. So it creates for interesting times. Something I want to talk about right now first is there's also consideration that the drought in China is part of the rally behind corn prices the last 2 days. That's not necessarily so, and I'm going to show you why. In the end, when things get down to the wire, yes, it can be a fact, but right now it's just a slight difference in their production. Let's go to China. Here, as I draw the lines, most of their corn and soybean production is up here in this ebb of the woods for their growing the last 30 days. This is a 30 days percent normal, and the 60-day looks like this as well. The drought is pretty much in the south. So if we go look at the corn again, notice how I drew. This is where your corn production is. Yes, there's going to be losses down here in these two provinces, but this is like worrying about losing North Carolina and Alabama on corn production. Yeah, it matters, but does it really make a big price difference? It will later on this year if we tighten up, and they are also on a hunting for corn expedition as well. Soybean production, again, bulk of that bean production is where the rains are. Yes, there's concerns. You've got about, 13% of the production here, 14% of production of beans are in this drought area. So that could be a problem, but not as hyped up as one would think at this time. Now, if we take a look at the rice production, here's where a lot of that rice is growing. Granted, about 23% up here in the Northeast, but a lot of rice is growing where this drought is taking place. And so you would think rice would be exploding. Well, domestically in the U.S., we're not seeing that. Our November rough rice contract did light up the last 3 days, but look at how it broke down to new monthly lows just last week, Thursday. And now we're on the verge of possibly breaking out of a 6-week pattern here, probably heading back to the highs made back in May, which would be near $18. Every dollar move here is about $2,000. It's a 2,000 hundredweight contract every 10 cents. So you go from 761 to 1771. That'd be $200. And so maybe there's something starting in the rough rice contract, but it's certainly not yet an effect on our beans and corn. That has to do with the crop tour and the ratings and our own U.S. domestic issues. Now, corn. The 44-day exponential moving average has been the most accurate one I've found to use here. The 200-day moving average had a lot of action here. I'll show you that later on. And the bears were working this. Now, we finally blew yesterday. The close just above it and blew up today. And several points I want to make. Back when this wave hit this new low on July 22nd, I argued the next week that maybe this was a false game. It's important to understand why being false is important. In the morning, corn had tagged that low, rallied sharply, then came back in the closing 5 minutes, made this whole fiasco. And then, of course, we gapped up that following Monday. If this wouldn't occurred, we'd change the outlook from here's 1, 2, 3, 4, 5 waves down. 5 waves in this direction implies a bear market. If it's 1, 2, 3 waves down and you turn up, it implies you're still in a bull market. If we eliminate this, we can say we're still in a bull market because the scenario that's setting up like I've said this before, even back during this time window, I'd said we have a coming scenario for corn where we can have exactly what we've had the last 2 years, carryouts dropping back to pipeline supplies, justifying a run at over $7.50 corn. So if we take a look at this, ignore this, then this was wave, after this low was in, this is wave 1, this is a deep wave 2, and now we're starting a wave 3 work here, which these waves are a 1, 2, extending a 1, 2, 3, and we're counting the wave 3. I don't want to confuse you. This is wave 1, this is wave 2. Now we are working into a wave 3 of 3, and so now we start the count all over again. 1, 2, 3. Now this leg may not quite be done yet. It may want to reach up in the 670 range, pull back, and then another push towards $7 before we complete wave 3 and do a fourth wave consolidation into harvest. And so what this implies, this moving average is now starting to turn up. When they turn up, it gives you support. So we come pulling back into any time period here, this will give us support. You'll also see it more in the 6-hour chart, which is trying to turn up here, implying that on the near term, 625, 630, solid support on any setback that they can create or think of or find a way to set corn back before we advance again. So corn pricing looking strong. Pullbacks are going to get bought now, and we're targeting now probably something into that 675, 680 area before we get a more significant pullback, fourth wave, and then see another push higher to 7. But ultimately, ladies and gentlemen, the way this is stacking up, if this in Indiana, Illinois, and Iowa crops don't really surprise the upside, we've got a carryout that's coming down, and the USDA has already started that from trend lines. Remember, it's at 181 bushels where we should be. They're already from 177 down to 174.9, so pushing it down to 172 is pretty significant. On the December corn, I wanted to bring this back up. I told you about that chart. Here's a 200-day moving average. The bears had a lot of fun trying to always hold the market. It would pop through it, pop through it, pop through it, and then yesterday got above it. It was too much to hold. This 44-day exponential moving average is more the corn market. So as we are turning it up, as she advances, that's going to be our support on setbacks. Soybeans blew through prior high of the 1465 range. Didn't close above it, which is interesting, but it's still very friendly. This action broke the downtrend activity. Again, here we have this 1, 2, 3, 4, 5 waves down, implying bearishness, 2 days worth of trading below this prior. So the bears want to say they own it. Or do they? Is this a 1 and now we're starting another 2 and another 3 advance higher? The way things are stacking up, we'll see. What we do know is this. We have a market that has rejected the bearish action from down below. Our congestion, we're trying to work through it. And so with that, let's go to our intraday chart. 60-minute hourly bar allows for a pullback easily to the 1440, 45 area. We can gouge here a little bit as they typically do, and then still keep turning higher. If that does break more, and I'll get to the next chart, then we'll probably find some pretty more significant support at 1430. Keep in mind, we've got the basing action going on here. So that's your 1, 2. And now we start a 1, 2, 3 expanded, 4, 5th wave up. So kind of in theory, in the short term, we could have a setback of an A, B, C. We tried shorting yesterday for that and was a little preliminary on that because we were working off the daily moving averages, which obviously are wrong now. So the point is we could get some kind of setback in here, probably in that 1430 range. You'll see it now when I go back to this chart, this purple line here, which notice when we get trendy, it tries to hold us. And so as we pull back, 1427, 1430, and then another assault higher, because I've been waiting for an attempt at the 1520 range. When this took place, we did this measurement, and then we said we'd do a matched up to 1520. That's probably what's in play. But on the very short term, we're probably going to retreat Wednesday into Thursday before they push there again. Wheat, Chicago. If you have our phone data and our software that we will give you for free if you're a trading customer, all you got to do is call us 1-800-359-0221. This moving average is the 25-day exponential. And notice how it's helping the bears. But today, pressed it. Then we found out that Egypt tendered from Russia directly. That caused our softening in price. But you can see here now a punch. Last week it was a punch over 825. This week we start punching through about 815. That's going to say we're breaking of trend to the upside. You can see it more on the Kansas City wheat. Here it is, green line. That's the 25-day exponential. It closed above it today. Be interesting if we don't sell off tomorrow. We're 3 days up. You get these 2-3 day rallies, and they'd like to drive it down again. We'll see if we can't if it doesn't pull back, maybe this cycle date's going to be a miss, and we're already bottoming out because the row crops are pushing us up as well. And so as the row crops move higher with the collapse that wheat has had, it works into the feed bunks. And so rising corn pushes the wheat values higher unless they want to just feed the wheat. Standout crude oil. We had been waiting for a push down into August 22nd. That was yesterday. We had projected that if we did a match decline, we would go to 85, 88. That was tagged last week. Yesterday's stock market collapse put her down, and immediately we took off on comments that OPEC said that if Iran does get to flow oil to stabilize values, they're going to restrict production. So that brought that oil right out of the hole. So what's next? We probably have a bottom. Do you just buy? Well, if you hadn't already bought in anticipation earlier in this, what you do is we wait on a setback. We are now officially closing today above the 92.5 range, 93, which gives us our breakout. Pullbacks to the purple line, the intraday purple line that you can load on your software we give you or on your phone that we give you. And as you can see, you can spike these purple lines. So a spike through 91.50 right now would target anything around $90 would be a place you'd want to buy into on this crude oil, somewhere around $90. Tomorrow's the Department of Energy numbers. Whether they can get a pullback into this, we'll see. But the way this stuff rocks and rolls around here, should get an entry here somewhere into $90 because we are now turning higher. And the hurricane season is coming too, starting September 1st. This is Eugene Grainer with Heartland Investor Capital Management. I hope you find this information useful.